Hello everyone, my name is Jack Evans and I'm Associate Wealth Advisor here on the Pegasus Capital Management team on the Infinitas Coordinated Wealth Council. And there's obviously been a lot going on in the last few weeks. Today is April 16th of 2025, and so everyone who's watching is well versed in what's going on in tariffs right now and how that's affected both the stock market year to date and then economic expectations going forward. One thing that you'll hear a lot from stock market commentators is to not sell your holdings. And while that's good advice, I want to provide some science and some statistics today as to why it is a smart idea to continue to hold stocks for the long term. And I made a LinkedIn post on these charts that I'm about to share with you, but it really boils down to three things. And the first thing is that recoveries have been much longer and stronger than downturns. So this chart that you have in front of you on the horizontal axis, you can see it goes back to 1949 and then ends mid-year 2024. But the bull markets are in blue and the bear markets are in red. And what you can see is that the magnitude of bull markets far exceeds those of bear markets. The average bull market total return is 265%, again going back to 1949. And the duration of a bull market on average is 67 months. In contrast, for an average bear market, the average total return is negative 33%, and the duration of that bear market is 12 months. So using this graph, I really like the way it's outlined. It really shows the relative power of a bull market compared to a bear market. And so that's the first reason during these tough times that you need to stay invested in the stock market. That's because to take full advantage of when the market recovers and you are in a bull market. The second graph I'm going to put out for you underscores that after large declines, markets have recovered relatively quickly. So in this chart in front of you on the far left side, it shows you periods of decline as far back as 1929 and as recently as the Great Financial Crisis of 2008. And so what you'll see on the right, or the one column to the right of that, was the drawdown, the decline. And so you can see, for example, the one from 1929 to 1932 was a pullback of 86%, if you can imagine that. But from there, the next five columns are the S&P 500 returns 1 year after the low, 2 years, 3 years, 4 years, and 5 years after the period of decline. And I'll go straight down to the bottom where it shows the average, where you can see the first year after these five declines, an average return of about 71%. After the second year, 12.7%. Third year, an average return of about 10%. Fourth year, average return of about 26%. And then the fifth year, an average annualized return of 10%. And so recoveries happen quickly. They happen swiftly, and I think investors were reminded of that in the near term as well. When President Trump announced the pause on tariffs, I think the S&P 500 was up 10% in 1 day. So just one bit of good news can turn the tide, and it's another strong reminder that market recoveries happen when you least expect them to, and so you want to be fully invested when that happens. The last thing to remember is that missing just a few days of the market's best returns can have a material impact on your ending balances. So the last chart I have in front of you is the value of a hypothetical $1,000 investment in the S&P 500, excluding income, from January 1st of 2015 to December 31st of 2024. And so on the far left side, if you had stayed invested throughout that whole period and were able to block out the inflation scare of 2022, the COVID scare of 2020, your $1,000 investment was able to grow to $2,869. One column over to the right, if you just missed the 10 best days in that 10-year time frame, your ending balance was 45% in missed value. So your $1,000 appreciated to about $1,500, but of course that's quite a shortfall from the $2,800 that you could have gotten if you were invested throughout the entire period. And then I'll skip straight to the right. If you had decided to get out of the market for an extended period of time and you had missed the 40 best days of market returns from January 1st of 2015 to December 31st of 2024, your $1,000 original investment would only be $689. So there's historical reasons, there's statistical reasons to stay invested during market declines. It's in your best interest, and so if you ever feel like maybe now is the right time to sell your holdings and you want to consult a financial advisor and get some advice, feel free to reach out to us here at 913-327-1627 or shoot me an email at jack.evans@pegasuskc.com. Thanks so much.